Welcome to the Deep Dive. Today we're taking a close look, a deep dive really, into the latest Q1 FY26 results for Hind Rectifiers Ltd. and their strategic moves too.
Yeah, our mission here is to unpack the key numbers, the operational wins and the strategy. See how this company, which is pretty crucial for India's infrastructure, is navigating things and, frankly, capitalizing on the current market.
Right, and we're drawing this from their official press release, the details from their board meeting financials included, of course, and their investor presentation. Pretty comprehensive sources.
Absolutely. So what you'll get from this is a clear, concise understanding, their performance, where they're heading, and what it all signals, especially for that really burgeoning railway sector they're so involved in. Okay, so first, Hind Rectifiers itself. This isn't a newcomer. They've got a really long history, established way back in 1958.
Yeah, in partnership with Westinghouse, Brake and Signal from the UK initially.
Exactly. And over 66 years, they've evolved into this major player in engineering and manufacturing. Quite the journey. It really is. And their expertise is quite specific. Manufacturing power semiconductors, power electronic equipment, and also railway transportation equipment.
So complex stuff.
Very. The product list includes power converters, control electronics, transformers, rectifiers, inverters, even motors and HVAC systems. They're building some really core electrical components for, well, a lot of key industries.
And that range means they serve a really wide market. We're talking railways, defense, power, even newer areas like hydrogen, plus steel, cement, chemical, paper.
It's a broad base. And they export too, right? Over 30 countries.
Yeah, with offices in India, Sweden, and the UAE. So a significant global presence alongside their Indian core.
And operationally, they've got two main manufacturing plants in Nashik and Punjab in India.
And about 950 employees backing that up.
A pretty substantial setup.
Okay, let's unpack these Q1 FY26 numbers then, because the top line growth is, well, it's pretty striking.
It really is.
For the quarter ending June 30, 2025, their revenue from operations jumped 58.5% year over year. That's INR 214.8 crore, up from about 135.5 crore last year. That kind of jump. What's driving that, you think?
Well, that's a huge leap. And what's fascinating here is how efficiently they manage that growth. Look at the EBITDA earnings before interest, taxes, depreciation, and amortization.
Right, the core operating profit.
Exactly. That surged even faster, up 66.9% year over year to INR 24.2 crore. And importantly, the EBITDA margin improved too.
So not just selling more, but selling more profitably.
Precisely. Margins went up by 60 basis points, hitting 11.3% compared to 10.7%. They specifically mentioned an optimum product mix and cost optimization, probably linked to those big railway orders we'll get to.
Makes sense. And that flows right down to the bottom line, the net profit after tax, or a PAT.
Yeah, that's on 85.5% jump year over year, hit INR 12.8 crore compared to just 6.9 crore in Q1 last year.
Wow. And they attribute that to improved operational efficiencies and financial discipline. It all seems to connect, doesn't it?
It does. And it's good to see their consolidated and standalone results are very similar, both approved by the board, reviewed by auditors, gives you confidence in the numbers.
Okay. And there was something about tax strategy, too.
Yes, they're looking ahead. They might opt for a concessional tax rate around 25.17% starting next fiscal year FY26.
And that had an impact now.
A small one, because they might take this lower rate later. They had to reverse and write off about INR 11.3 million in something called MAT credit entitlement. Think of it like tax credits they'd built up.
So giving up some past credits for a potentially better rate going forward.
Essentially, yes. A strategic financial move.
Okay, so strong financials. But the operational side, that's where it gets really interesting, especially for a company like this.
Definitely.
Let's start with the order book. It hit an all-time high, INR 1,025 crore as of June 30th.
That's huge. Over 1 billion rupees. That's a lot of future revenue locked in.
And primarily driven by railway sector expansion and government initiatives, they say.
And you can see that clearly. Indian Railways placed orders worth INR 327 crore just in this quarter alone.
Wow, almost a third of the new orders.
Yeah, including two big ones, one for 127 crore, another for 101 crore, both for locomotive products. It shows a real reliance from Indian Railways on them.
And it's not just about getting orders, is it? They're innovating, too.
That's right. They successfully commissioned their own indigenously developed propulsion system.
For Indian Railways.
Yep. And it's now been allocated for field trials. That's a big step. Plus, they got a significant order for a next-generation propulsion system for passenger locos.
So they're pushing the tech envelope.
Clearly, and pursuing more opportunities there, too. It underlines their strategic focus. Indigenous development, innovation, and, just executing well, building things reliably.
Right. And to support all this growth, the boards approved a preferential issue of warrants.
Yes, worth about INR 27.4 crore. It's to the existing promoter group, still needs shareholder approval, though.
And the aim is explicitly to propel growth across the key business segments. So investing back into the business.
Exactly, fueling that expansion.
Now, if we connect this to the bigger picture, these results aren't happening in a vacuum, are they? Especially with railways.
Not at all. The context is crucial. Indian Railways is making huge strides. They're aiming for Scope 1 net zero emissions by 2025. It's incredibly ambitious.
Wow, 2025.
And Scope 2 net zero by 2030. Plus, think about this. India is now producing more locomotives, about 1,400, than the U.S. and Europe combined.
Really? That's quite a stat.
It is. And they've added 2 lakh new wagons. It's a massive upgrade and expansion happening across the board.
And you see the government spending backing that up. Annual capex for railways and metros is around $35 billion US.
And growing over 8% year on year, based on forecasts. Plus, the government's general focus on manufacturing with big projects.
Like the Mumbai-Ahmedabad high-speed rail.
That, the dedicated freight corridors, the indigenous Kavach train protection system,
Yeah.
It all creates this massive demand environment.
Which Hind Rectifiers seems perfectly positioned for.
Exactly. Their strategy lines up perfectly. They're leveraging these industry tailwinds. They have the capability to execute on that huge order book.
And they're investing in R&D, right? You mentioned that earlier.
Heavily. Over 100 engineers, 20 new products under development. They're pushing into new tech power electronics, signaling, telecoms for railways.
Mind diversifying, too, not just railways.
Right. They mentioned looking at HVAC systems for other vehicles, for instance, expanding into new industries and markets.
So the growth drivers seem clear. Boost manufacturing capacity, focus on growth and margins from these big government projects, maybe some backward integration.
Plus product innovation like those new propulsion systems.
And actively chasing new clients, new geographies. You mentioned marketing in Europe and South America.
Yes, that's part of their plan, broadening their horizons.
Okay, shifting gears slightly. There were a couple of other keyboard decisions mentioned, one about their Sweden office.
Yes, they decided to close the Sweden branch. It was set up in 2019 for the European industrial market.
Yeah, the reason?
Well, the official line is that while they made reasonable progress, they feel Sweden isn't the right location anymore, given their new strategic initiatives.
Interesting. So not pulling out of Europe entirely?
No, they plan to relocate to another EU country that's a better fit for their product requirements.
Yeah.
It shows they're willing to adapt their international strategy.
Makes sense. And finally, something about ESOPs. Employee stock options.
Right. The Nomination and Remuneration Committee allotted just over 21,000 equity shares under their 2018 ESOP plan.
So employees exercising their options.
Exactly. At a price of INR 85 per share, it increases the total issued share capital slightly. It's about aligning employee incentives with the company's success, keeping the team invested.
Okay, so let's wrap this up. Key takeaways for you, listening. We've seen a company, Hind Rectifiers, with really strong Q1 financial growth.
Yeah, impressive top and bottom line increases.
Driven significantly by a record order book, especially from the railway sector, which is clearly booming.
And underpinned by serious R&D investment and a strategy that seems very much aligned with India's big infrastructure goals.
They seem to be firing on all cylinders, really.
Which leads to an interesting thought, doesn't it? They're focusing hard on indigenous development, building things in India, but also expanding globally. So how might that decision to close and then relocate their European base actually impact their long-term competitiveness outside India? Does it open up better opportunities, or does that kind of create new challenges for capturing those non-Indian markets?
That's a great question. What stands out to you about Hind Rectifiers' quarter or their strategy going forward?
Yeah.
Does this deep dive spark any other thoughts or questions for you? We genuinely love to hear them.